Good morning and welcome to Markets Now. I'm Michelle Rook along with Kent Beta with Paradigm Futures. Well, kind of a mixed start this morning in the grains and the cattle futures. Hog seeing a little bit of pressure once again. And I want to start off talking about wheat, Kent, because wheat back to the plus side here this morning. And I'm wondering, are we putting in a little war premium in that market?
I think that we are, Michelle. When you look at the situation that, we're on the verge of another major offensive from the Russians. Um, and, we know that they planted less winter wheat. We have to wonder about whether or not they're going to have the ability to harvest everything that they've planted. Right now, it certainly appears as though the war is not going to be over anytime soon. And, last year, of course, when the war started, they already had a crop in the ground. This year's crop that they have in the ground is smaller. The marketplace has been optimistic over and over that maybe this was going to come to an end at some point and that things were going to be a little more back to normal. And while there certainly have been exports through that agreed corridor, the tea leaves kind of point toward an escalation in violence, and that can't be good for wheat production in Ukraine, which certainly tightens up the whole world wheat balance sheet.
Yeah, and from a technical standpoint, although we couldn't get above some resistance areas on the charts in any of the classes last week, we're also down into support areas that look like they're holding.
Yeah, the support all month has been holding. We did at one point make a contract low, I believe in the Chicago contract, but we rejected that and managed to move very quickly back off of that level. I think that we have to keep in mind that while we can't trade the dry conditions in the Southern Plains every day, the situation down there is still significant. Crop conditions are still, fair to poor in most cases, and it does matter here for domestic wheat values as to whether or not we're going to be able to produce a decent crop or not in hard red winter wheat territory.
Right. So we do need to hold a little weather premium in that market. Corn market this morning, we've been on both sides of steady, pretty quiet trade there, even though we had some export business to Mexico and Japan on flash sales this morning, which should be supportive. But are we kind of stuck between higher wheat and the lower soybean market this morning?
Well, to begin with, I think the sales are pretty routine. Those are things that we expect to see, and the market doesn't get too excited about it. Second thing I just note is that we've run into an awful lot of resistance in that 85 to 87, 88 area.
True.
And as we, get back up above or challenge 380, you're going to bring out some more producer selling. We didn't get a commitment of traders report on Friday, and it just sort of felt as though the funds have some interest in continuing to sell this rally and potentially just trade this range. So, the other thing that we saw last week is that on breaks down toward 670, and certainly I think if we were to get down to 665, you'd find an awful lot of technical support, a lot of end user pricing. We just feel like we're stuck here in a range bound sort of trade here for a while.
You bet. So soybeans, we did make some new contract highs in soybean meal on Friday, got above the $500 mark. Soybeans had a run of, over 20 cents higher last week. So is today some profit taking that we're seeing in terms of pressure in that market, or is this a result of maybe some China tensions?
Well, the China tensions certainly have, are out there now. From a soybean itself standpoint, I don't think that the issue is going to be very significant because the majority of the Chinese program has already been sold and shipped. China is going to very quickly be moving their procurement to Brazilian origin. And of course, Brazil probably has a fairly good crop. On the meal specifically, however, as we get up toward that $500 mark, if we look at history, you can see that $500 is been pretty good area where demand has been rationed a little bit. We just don't tend to seem to be able to stay above $500 very much.
Right.
I put a little comment in my commentary this weekend about, our hog producers, poultry producers that have coverage in meal, to maybe shift that coverage from long futures into call spreads, to reopen up some downside, maybe to book some of those profits in meal, because this is just an area that we're not able to maintain for very long.
So we also have a WASDE report coming up on Wednesday, and so maybe a little bit of position squaring ahead of that, although some of these early trade guesses look like maybe a little bit higher ending stocks in corn and wheat and not much change in soybeans.
Yeah, the higher ending stocks in corn, there continues to be expectations that exports are going to come down a little bit. It wouldn't shock me to see the USDA make that change. However, as we know, we had a really good week of export sales, and we need to keep in mind that the Brazilian is going to be shifting their logistics away from corn exports and into soybean exports, leaving most of the corn market for the U.S. here for this March, April, May, June timeframe. I do think our export sales are going to pick up. If they lower exports, it wouldn't surprise me if in a future month they had to raise them again. I would also say that if you look back in history, when we have enough corn to export, we've very seldom been able to bring our exports down below about 1.8 billion bushels. We're now at about 1925. So we have a little bit of room yet to go in our ability to lower exports, but I don't think we're going to get too much less than what's on the balance sheet right now.
So cattle put in a nice week last week, new contract highs. We had some steady to $2 better cash trade in the north on Friday. Still don't know where we traded in the south or if there was much trade at all on a cash basis. But let's just talk about this market this morning. Feeders seeing a little strength, but we're kind of mixed in the live cattle futures. And so do you anticipate we're going to consolidate here now, or are we going to see funds buying on these breaks?
Well, funds like to buy new contract highs. And of course, we made new contract highs last week. So I suspect that any breaks are going to be well supported by the speculative community. However, the cattle feeder has been told, quite frequently that, things look bullish and we're going to make new highs, and we hadn't been able to do it for a long time. And now we've actually got it. And, I think we're in some areas that are going to provide some good profitability for cattle feeders despite the high corn price. I just wouldn't be at all surprised to see some continued hedging from the cattle feeder against these higher prices to lock in some of the margin that they're currently given.
That makes sense. What about the hog market? A little pressure again. It seems like here the opposite is true. The funds seem to be selling on just about every uptick in this market, and that seems a little concerning yet.
Yeah, well, it certainly is, and some of it is just balance sheet related. If you remember on the January report, cattle or beef production, forecast to be down about 6.5% in 2023, while pork production actually is forecast to be up a little bit. And we have some pretty high hog prices and pretty profitable hog prices. That being said, this past week we challenged the June contract at $100 on 2 different occasions, managed to close above 103. I think we're going to find some decent support around $100 in the June, and I actually think we've got a reasonable chance of seeing that market correct back into that 105, 106 area at some point in time.
All right. Then there again, we'll probably see some hedge pressure when that happens.
Absolutely.
All right. Thanks so much for joining us. Kent Beadle with Paradigm Futures. That's Markets Now.